So the term cash rate,
The cash rate.
Official cash rate.
The cash rate.
The cash rate.
comes up a lot nowadays. And you probably know it's got something to do with banks and home loans, but what does it actually mean? So the first player you need to know about is the Reserve Bank of Australia. It's our central bank, a regulator that makes sure all our financial systems are running smoothly. One of the main ways they do this is actually by controlling how expensive it is for the commercial banks to lend money to each other. See, commercial banks always need to have enough liquid cash on hand just in case they need to give it back to their customers who are withdrawing money. So the situation might come up where, for example, Westpac might have a bunch of customers withdraw money one day, meaning they're a little short on liquid cash for tomorrow. So they could go get an overnight loan from another bank, maybe ANZ. ANZ gets to charge Westpac a little bit of interest on that loan, they make a bit of extra profit, everyone's happy. But why am I telling you this? Well, that specific interest rate, that one used between the banks, is the cash rate. And as I mentioned earlier, the RBA uses its influence over the cash rate to basically set the vibe of the Australian economy. They set a target for what they think the cash rate should be, and every month their bigwigs all meet to decide if that target should go up or down. But how does all of this affect us mere peasants? Well, the cash rate target changing doesn't mean that banks are obliged to change their interest rates, the ones that they charge their customers for things like home loans or business loans. But if the cash rate is lower, it's cheaper and easier for all this money to be moving around, and that means that some banks will feel more comfortable lowering their own interest rates. And once a couple of banks do that, the others usually have to follow suit in order to stay competitive. Thus, you see how this vibe setting starts to take shape. Let's say the economy is slow, everything's a bit stagnant, no one's buying enough. The RBA can bring that cash rate target down. Banks lower their interest rates to stay competitive. Lower interest rates means home loans, business loans, all of that suddenly becomes cheaper, and also the money individuals have in their savings accounts are suddenly earning less interest to boot. So all of a sudden it will start to make sense for people to go out and buy that house or start that cafe or whatever. On the other hand, maybe the economy is moving too fast. Everyone's buying and investing so much, prices are going up, inflation is getting too rapid. Well, in that case, the RBA might bring the cash rate target up. Banks will all raise their interest rates as a result, loans are going to get way more expensive, and eventually savings accounts will start making better interest. This means that there will be a portion of people who decide that actually no, it would be better to save rather than invest right now. And thus, the economy cools down. Now, the cash rate isn't the be-all and end-all of economics. Australia's commercial banks also borrow a fair chunk of their cash from international markets. But again, this is all more about setting the tone. Basically, the cash rate is a roundabout way for the central bank, the RBA, to hypnotise us into spending the right amount of money to keep the economy healthy. It's very weird, but now you know.